Hi, guys. Welcome to the How I Raise It podcast, a show where you get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Martin Tobias of Incisive.vc, a venture fund that invests in startups that reduce friction at scale across Fintech, SaaS, marketplaces, and other verticals. We talk about how poker is a metaphor for investing in startups, how he transitioned from angel investing to raising a fund, advice for emerging VCs, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup, or Fundingstack.com if you are a VC or advisor to get an awesome collection of tools for raising capital. It includes a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Martin.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and Fundingstack.com. Today I have Martin Tobias of Incisive.vc coming to us from Spokane, Washington. How's your day going?
Hi, it's great. Sunny, got the pool all ready to go this weekend. Kids are excited to jump in.
Wonderful. Now, in our little pre-call, you mentioned you just got back from the Liquidity Conference, Jason Calacanis's shindig.
Yeah.
Tell us a little bit about that. How'd that go? What'd you learn?
Well, it was fun. It used to be called the Angel Summit, and it's basically for high net worth angel investors, general partners, and institutional LPs to get together. It was small, about 150 people. Some content during the day talking about trends in venture capital and stuff like that. But basically every night for 4 nights there was poker until like 2 a.m. And also one afternoon we got to go shooting, did trap shooting and stuff like that. It's basically just an excuse for VCs and LPs to get together and meet each other and chit chat. I knew a bunch of the other managers and it was a lot of fun. It was funny. I'm not that famous. I don't have as many Twitter followers as Jason does, but I have a pretty material number of them. And every time I go to these events, I have like 20 people walk up and it's like, hey, Martin, I follow you on Twitter and blah, blah. And you get to put the face to the name, which is always really a fun thing to do. And I love it. And, they did an episode of the All In podcast too with Chamath and David and everybody there. And there's a lot of similarities, I think, between poker. There's a reason why a lot of people in venture capital and entrepreneurs play poker because there's a lot of similarities. Basically, it's a game of incomplete information where you have to invest money to get more information. And you have to, at each step, decide, did your odds get better or worse? And that's very similar because like in poker, you start playing Hold'em, you start off with 2 cards. You don't know what anybody else has. You don't know what the next 3 cards are coming. And you have to make a decision. Is the information I have good enough to put capital to work? That's very similar to meeting 2 guys starting a company for a half-hour meeting. You got to decide very quickly, are these people in the top 10% of people I've ever met? Or do I want to spend time trying to get to know them? And give them a little bit of money to get going. And let's say you do their angel round, and then in the pre-seed round, they have built a product, they've got a few customers, they're asking you for more money. And that's like after you have the flop in poker, you get 3 cards, you get to decide, did my odds get any better or worse, or do I like what's happening here? You have another decision. Do I put money to work?
Totally. Interesting. Yeah.
So I think it's a very good thought process of basically making risk-adjusted capital allocation decisions in a low information environment, which is basically venture capital.
That's a great metaphor. I totally understand that. I don't know if you know a guy named Bob Crimmins of Startup Haven.
He's
I'm
an LP in his fund and I've played at some of his events.
There we go.
It's also, I think there are a lot less about the money in his events than Jason's game. That was a pretty big, crazy ass game. But it's also a very great scenario just to network and meet people. Like instead of just standing around drinking cocktails, you're doing something else where you are talking about deals and companies and you're getting to know people in a different environment. I really like it as a networking event.
Love it. I know how to play poker, but not really very well. I need to level up on that, I think. Anyway, cool.
Excellent. You're invited.
I'm invited. So you can take all my money is why you're invited.
Exactly. That's the
Yeah,
kind of, you're the kind of people we love at the table.
exactly. Perfect. My wife would love that. Let's get into what you do. We'll come back into, you know, the two guys and an idea kind of thing. But let's talk about Incisive VC. What's the
Yeah.
overview of Incisive?
So Incisive Ventures is the name of my venture firm. I have been an angel investor forever. I was at Microsoft. I was a 3 times venture funded CEO. I'm an LP in 17 funds. So I've been doing investing on my own and through funds for a long time. But basically, when the pandemic started, I was running a company in LA that got shut down by the pandemic, and we reset it. It's doing fine now. But I had the decision, like, do I want to go back to being a CEO, or do I want to just invest full time and or do something else? And frankly, I couldn't think of what kind of company I would start in the middle of a pandemic. So I'm like, maybe I'll start investing again. And I have about a $2 million a year allocation out of my own account to write checks into early stage companies. So I just started writing checks. And then a bunch of my friends were like, hey, I see you're investing kind of a lot lately. Can we invest with you? So, I started a syndicate on AngelList, and AngelList has been a great way to share deals and get your friends to invest in companies you like. It's a lot less friction than the old way of pulling angel rounds together, which is where you'd send the deck around to your friends and they'd all have to meet the CEO and there was no sharing of diligence and whatever. So I started doing that with like 50 of my friends, and then I ended up building one of the biggest syndicates on AngelList. I have over 3,000 LPs. And a bunch of my LPs were like, we love what you're investing in, but we don't want to do this deal by deal basis. We just want to invest in everything you do. Would you please start a fund? And I used to be a venture partner at Ignition Partners, which is quite a big fund, or was a big fund. They're now gone, in Seattle. And they invited me to be a GP in one of their funds. But being a GP in a $400 million fund with 4 other partners and CalPERS as your LP, with a huge back office. At the time, you had to have your own controller and all that. It's very hard to run a venture fund 10 years ago. And I thought it was too hard. But basically today, you can buy the back office in a venture fund as a SaaS product through Carta or AngelList or Decile Group. And it's possible to be a single GP today, whereas maybe 10 years ago, it was basically not possible. The expense and complication of running a fund was too hard. So that's actually something that those companies have done, like software companies have done for lots of industries. They've made it really easy for people to enter that industry, like Shopify did for e-commerce and stuff like that, right? There are software platforms that make it easy to run a venture fund. So I'm like, oh, maybe I'll start a venture fund. And I started a small one on AngelList and deployed that. And this is my second fund, but technically my first fund where I own all the LPs. It's a $10 million pre-seed fund. I'm doing just B2B software investing. And this is what I'm going to do for the rest of my career is be an investor. And I'm an operator turned investor. And I'm seeing a lot of the smart CEOs realize that there's a value to have an operator VC on their cap table as opposed to, a 24-year-old MBA who just graduated from Harvard. So
Sure. I agree with that, but of course I've got gray hair, so of course I'm going to agree with that. But
of course, I think there's a place for both. But I'm seeing, a lot of the smart CEOs say, I invested in a company last week where the founder was not raising. He was a second-time founder, had plenty of liquidity, didn't need venture capital, had been reached out to by a bunch of the multi-stage funds because of his background, but basically said no to all of them because it was a junior associate calling them. And we met and we really vibed. I knew a lot of the same people as him, and I could help him with business development. And he's like, hey, you've run a company like I'm building. I'd really like to have you involved. And I think the smart ones are realizing that, they can pick their venture capital partners. And when you find the right venture capital partner as a founder, it's a magic scenario. It really is.
So let's get into that. Let's get into that sort of matching and dating and matching. What are you looking for? Give us the criteria, the sandbox, all that good stuff. Deals you're looking at.
Well, there's a lot of sort of general advice to founders out there about if you want to raise VC, and most of it I think is kind of bullshit because frankly, you really need to understand what you want as a founder and what the value add or the experience of each individual investor is. And you have to do a lot more research. And what I talk about, I started being, I'm not as famous as like Jason on Twitter, but I have a top 1% account, like 30,000 followers. And I started putting out a lot of content on Twitter because basically what I'm trying to solve for is this information asymmetry and this low probability matching game, right? Basically, founders here know 99% of the time. VCs say no 99% of the time. What can solve this low probability matching game that we're both, voluntarily doing with our time? Well, more communication and having a better screen to find the right fit is part of that. So that's why I put out a lot of content on blogs. I do podcasts like this because I'm not telling you how to raise venture capital overall. I'm saying, if you want to pitch me, here's what I'm about, here's what I like. And I think that founders should find that out about every potential VC that they're looking for. For example, so what I'm looking for, I'm a pre-seed VC. I do B2B software. I invest in, I call companies that reduce friction at scale. When I was at Ignition, we were the first investor in DocuSign. DocuSign is software that makes a business process better than it was before. There's lots of those business processes out there. I'm looking for companies like that. So I don't invest in B2C. I don't invest in consumer. I don't invest in CPG, drug discovery, crypto. I say all of that on my website, in my tweets, stuff like that. Crypto entrepreneurs still send me their deck, which I don't understand because I'm very public about the fact that I do not invest in crypto. But I'm telling you that not to say I'm an asshole and I don't like crypto, but it's like, go find an investor who loves crypto. Don't waste your time with me. I'm trying to help the CEOs. So I do B2B software. I do pre-seed. I wrote a blog post about this of how I define the different stages. And for me, pre-seed means you've already raised an angel round of, say, $400,000 or $500,000 and built your MVP with that angel round, friends and family round. That's the idea phase. If you've got an idea and no code, I'm not the right investor for you. I need you to have your MVP done in the marketplace with a couple customers for at least 3 months. You're probably generating $5,000 or $10,000 a month of revenue. You have a development plan to build some more features that your POCs are telling you need to build. And you've got a pipeline that has a reasonable chance of getting you to $400,000 or $500,000 a month or a year of ARR to where the seed funds are going to start to get interesting. You're probably raising $1 million to $1.5 million in that pre-seed round. That's the perfect round for me.
Good. And typically leading, co-investing, following?
I will do either. In a $1 million or $1.5 million round, I'm a $250,000 to $500,000 check. Sometimes I'm the lead. Sometimes I'm a co-syndicate. The reality is those rounds are normally put together with 2 or 3 funds like mine, plus some angels. And it's not, you don't have typically the lead scenario like you would in an A where one guy's taking, 80% of the round. Typically these are more party rounds, and each investor is doing something slightly different. It turns out, according to Carta data, the average check in a $1 million pre-seed round is $25,000. So the vast majority of pre-seed rounds are really angel rounds. I'm trying to put a $250,000 check in there. So I'm trying to get 10 times the conviction of the angels in that pre-seed round. And there's a value to have real institutions in your round because we've got follow-on capital. We help you get introductions to other investors. I mean, that's the difference between me being a pre-seed investor and me being an angel investor. When I was an angel investor, I was just meeting CEOs I like. I'm like, here's $25,000, here's $50,000, good luck. And frankly, I helped them with some business development introductions, but I didn't have in mind, like who to introduce them to for the A or anything like that. But professional VCs, one reason to bring them into your pre-seed is they have a network. They go to events like this, liquidity event. They meet other VCs. They have a great network that you will have a higher likelihood of raising your seed or your A if you have professional VCs in your pre-seed than if you have all angels. That's just the reality.
That makes sense. But even with, the professional VC label, I think I saw on your website, you've made 250 investments. So how could any human help that many startups?
Well, that's all of my angel rounds. So that's not this fund. This
Right,
fund has 8 investments in it. and this fund will do 30 investments. So my commitment to my fund investments is an order of magnitude higher than my commitment has been to those angel investments. And that's one reason why I professionalized what I did in a fund, is because I have venture partners, I have software, I have all this stuff to help my portfolio companies in a way that I did not as an angel.
Yeah.
And I think it's better for the founders. I'm also writing a larger check. My average check as an angel was $25,000. My average check is $250,000 today. So I get a lot more attention, and I'm willing to do a lot more for CEOs that I'm writing 10 times the check into. That's just the way it is.
Sure. I like that. So while we're on this topic of what you invest in on your website, you've got a couple meta themes, which are pretty interesting. One of them, Americans are lazy. I like that. B2B is eating the world. That was formative when I launched Foundersuite. That was kind of one of my, or software is eating everything. Sorry. Platforms win. Any other kind of more intangible things you're looking for?
Well, I encourage founders that want to pitch me to read my meta themes, because those are the things that I'm looking for.
Right.
You got to fit at least 4 or 5 of those 7 meta themes for me to be interested in you. And I have and since I put that post out, I think it works, because a lot of founders will come in and go, here, I'm going to tell you how I fit into each of your themes. This is and it's helpful. It just makes the conversation go faster. I mean, they're all there. The thing on laziness, the reason I got that when I it came from a public market investment when Starbucks was going public. I called a friend of mine and I said, should I invest in Starbucks? And he said, Martin, they're selling a legal addictive drug that you can make at home for a huge premium because Americans are lazy. And if you think about Starbucks, you can make coffee at home, but you're going to pay like 50 times what you can make it at home because you're lazy and you want the fancy drink, the complicated espresso or whatever, or I even get drip coffee. But the convenience factor, and you look at other companies that have mined convenience. I mean, what's the difference between Amazon and Walmart? I mean, buy now, ship to your door, don't have to get in the car. It's the same, at-home fitness. Why did Peloton blow up? Because I can do it at home. I don't have to drive to the store. Like anything which allows them, and that goes back to my core thesis, which is reducing friction, right? Friction is anything between what people want and how they get it. And you can reduce friction in a lot of different ways, but allowing people to be lazy is good. One of my best investments as an angel was a company called Catalyst Fitness, which is at-home electromuscular stimulation. It's a workout suit for strength training, kind of like a Peloton, except for strength instead of cardio. But that's doing that same thing. Like I can work out at home in 20 minutes. It replaces an hour and a half of weight training. It works as good as an hour and a half of weight session, but I do it at home. I don't have to drive. I don't have to go to the gym. Like it frees up time. It allows me to be lazy. I can literally stand there and watch TV and get a workout in. Anything which enables people to frees up time, allows them to do more with less. It can be a great investment.
A couple other portfolio companies that are, just to kind of paint the full picture here. What are a few others that you'd like to maybe call out?
Well, I mean, I've been investing on this B2B thesis in the last sort of 5 years. I've invested in 74 companies, a subset of those 250, but this is all the B2B pre-seed, trying to reduce friction at scale thesis. 6 of them have been unicorns. And so that's about a 9% unicorn rate, which they tell me is better than average, like way better. One of those companies was Deal, for example, which is the employer of record. And that's B2B software, helps you hire people internationally, onboard employees, HR benefits, stuff like that. And basically, the reason I invested, first of all, the team's great. But second of all, as a CEO, I had used the competitor, which was TriNet, and TriNet just sucked. So anytime you're seeing a pitch from a company where the incumbent has very low NPS and people hate them and they have like huge market share, you go, okay, maybe that's something where, you can make better software, reduce people's friction, because the friction is the software kind of sucks, right?
Right. Yeah.
So Deal had the double whammy of, enabling these remote teams all over the world at a time when that became very important during the pandemic. So Deal is one, Enable is another one. I was a pre-seed investor in OpenSea, and I say I don't do crypto, and I don't. but OpenSea is a marketplace. It's not exactly B2C, it's more B2C, but basically, crypto's a gambling game. Like crypto's a bunch of gambling addicts like trying to make money. There's no real use case for crypto. But if a gambling game is going on, you want to be the house. You want to be the casino. You want to be the guy taking a rake on all this stupid shit that's going on. And that was what OpenSea was doing. And I'm like, okay, I understand that. They're the casino in a gambling game. I want to invest in the casino. I don't want to invest in any player or any particular game.
Yeah.
I want to make money no matter who wins.
Yep, I like that. That makes sense. Cool. All right. Anything else about, what you're looking for? Last chance to
No, I mean, my meta themes are there. When I'm meeting somebody pre-seed, they have some amount of software, but it's really like 2 or 3 guys and a dog. And so I look a lot at the team. And there are 4 things that a pre-seed company has to do. I very rarely found it in one person. Those are, you have to raise money, you have to sell your product, you have to build your product, and you have to operate your company. I typically find it works better if you have 2 or 3 people doing those 4 jobs instead of one person. So I have a slight preference for, 2 or 3 co-founders. Very rarely you can find one person that can do all of that, like an Elon Musk. But typically, you need 2 or 3 people in your founding team. That's the only other thing that I would say.
This is a hard question, but beyond the product, the metrics, the traction that product has, when you see founders, how do you know these guys are it? Like these guys have got the it factor. How do you identify the it factor? Maybe ask it like that.
Well, that's a very, gut type of thing. But the reality is, just like poker, just like surfing, which I do a lot, venture capital is a pattern matching game.
Mm-hmm.
And I have met over 10,000 founders because I've been doing it for 25 years. And I can tell within 5 minutes of meeting a founder if they are in the top 10% of founders that I've ever met. It's just obvious.
What are some clues? What are some little...
Now, ask me what exactly that is. I can't tell you all of it.
Yeah.
But some clues are, that they've been a founder before. It tends to not be a good thing if they've only worked in big tech and this is their first company because they don't know what they're getting into. So, you can tell that right away. Also, the second thing I look for is an innate curiosity. One of the things I do a lot is I ask them hard questions. And if the CEO gets defensive, I was just on a call today and I asked him a hard question, the CEO got really defensive. That's a huge red flag for me. Mm-hmm. If I can get you to be defensive in 5 minutes, what do you do to your customers? Right? So I actually try to get them to be defensive, and the best founders will not be. They'll be curious. You ask them a question about something they haven't thought about before, and they might say, well, that's an interesting question. I'm going to go research that, or I'm really curious about that. Instead of saying, the wrong answer is, that's a stupid question. Nobody cares about that, right? So I look for innately curious founders that have some deep insight into the market. The other thing I look for is founders that can get their first customer. Because in pre-seed, frankly, with AI co-pilots and all of this stuff, building software is not that hard. Having an idea is not the hard part. The hard part is getting your first 10 customers. So I spend a lot of time in that first meeting trying to figure out, have they worked in the industry before? Do they know people to get the first 10 customers? I assume they can build the product if they have a technical co-founder, but it's really a lot about understanding that founder's relationship to the industry and what their unique insight is. I love the story. Most founders have some formation story, right? I met a founder yesterday and they were building something to help home care of senior people. And his story was, I had to take care of my 90-year-old mother and I had all these problems and I didn't understand how to do it. But he's solving a personal problem.
Yeah.
So I tend to find that founders who are solving a personal problem that they have somehow some investment in, and that they gained a unique insight into that problem, having to solve it themselves. They went looking for a solution, to try to buy a solution, tried to do something else, and they got frustrated and they got, well, I guess I have to build something. That's a great founder story. A bad founder story is, I was in business school, I read a Gartner report, the top right quadrant looks good, I'm going after that market because Gartner says it's good.
Yeah, absolutely.
That is not a top founder. You want to find that founder, you want him to tell you in the first meeting, why is he building this versus anything else he could be doing? And why does he have that extra oomph to go through those shit sandwiches that he's going to go through?
I 100% agree. I tell founders that all the time too. If you're not truly passionate about it, you're going to give up when it gets hard, and it gets hard really fast and gets really hard. So.
And I asked them questions about, like, tell me a story about where you sort of pushed through before, where something that was hard that you did and stuff like that. And what is your motivation what motivation do you bring to this problem that's going to get you through all the problems you're going ahead? That's the key for me, that even if they're a first-time founder, they have to have some authentic skin in the game of why this solution they want to build must live in the world.
Okay, one more question about kind of what you're looking for and getting in front of you, and then we're going to shift gears to some other stuff. But I see you have a form on the website. I want an honest answer on this. If I'm a founder, is it better for me to fill out this detailed form or to skip the form and find some connection into you? Or both?
Always the form.
Always the form.
Yeah. And the reason for the form is that, I know some people don't like it, but the reality is I get 300 pitches a month. And if you are cold emailing me, and my email is in all sorts of databases and I get spammed all the time, that is an incredibly low probability event to talk to anybody cold email. But venture capitalists are even worse because their emails are everywhere. And the problem with me dealing with cold inbound is that it's not in a structured form, right? In my form, it's structured, and I actually have software which goes through and ranks things and looks at their LinkedIn profile, looks at the first-time, second-time founder. I have an AI bot which reads the deck and scores the deck for me and stuff like that. I ask questions about what industry you're in, and the crypto founders will not pick crypto, they'll pick Fintech to try to slip through my filters, which is really stupid. But anyway, I put it in a structured database because I can apply logic to it, and I can help analyze it much faster if it's in a structured database. If it's in an unstructured database, it's just harder. Like, the average VC spends 3 minutes to read a deck. If I were to read 300 decks, I would be doing nothing but reading decks. I just don't have the time.
So to be clear there, my question was actually not form versus cold, but form versus a warm intro.
Well, I take warm intros, and I like, if other founders send them to me, or other VCs, I'm happy for those. I will respond to those emails, and you know what I'll respond with? I would love to hear more. Would you please fill out my form?
Right. Yeah.
Because I have a whole workflow about how I rate these things, and I have automation which automatically asks for a meeting if I want to go to the meeting stage, right? I have all this automation that helps me do my job.
Yeah.
And it's all driven off of the form.
Interesting. I get asked this question. I gave a webinar 2 days ago to 150 startups, and they asked, should I go to the form on the bottom? And usually I say no, because I think those forms are usually read by an intern or an analyst or someone who does not have decision-making authority. Now, I think you're kind of a bit of an exception. So,
well, that might be the case in a big firm, and obviously, like, if you're a big firm, you got a bunch of associates and you deal flow and blah 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 blah. Going directly to a partner would be better. The problem is that partner gets gone to directly a lot, and the question is, what does he do with his email, with his inbox, right? The reason for these forms at all of these firms is that they have a workflow built off, and this is how they process their pipeline. And they consider, I consider all of them in the pipeline. I'm able to process it if it's in the form. I'm basically not able to process it otherwise.
Yeah.
And I'm a solo VC. I do everything myself with the help of one or two guys. The bigger firms, maybe you're right, but I still don't think that it helps to go directly to a partner at a bigger firm, unless it's coming from somebody that's leading around, that's already co-leading, that's already invested. Just a referral on a company that has not had any other investors yet, that's an incredibly low success rate. It's just really hard for them to process that. These forms are there for a reason because they have workflow built around them.
Okay.
And they appropriately score them. Like Hustle Fund. Hustle Fund has a form. They get 10,000 submissions a year.
Yeah.
If I said, and sometimes I do this, I have a company that's raising, I'll send it to Elizabeth Yin, one of the partners, and she's like, great, thank you for that. Please have them use my form. Even though I sent it to her.
Yeah. Yeah.
She's like, that's how we run our firm.
Right. Yeah. And it makes a lot of sense for them too, because they're also super early stage and they have a whole workflow and system, and it's more that data driven VC than the gut feel of VC, I think, in their case. So
well, absolutely. And I make personal introductions. I don't think that's as much the case in a Series A firm or something like that. I make introductions personally to partners for my founders and those emails get opened, and some of them have a form and some of them don't. There's many fewer forms in the Series A, but certainly in the high volume pre-seed and angel, it's the only way that guys like us can handle the deal flow. It's the only way.
All right, I want to shift gears a little bit. You've talked about raising your fund already a little bit. It sounds like it was kind of organic. You had friends that were already doing your AngelList syndicate, and you pushed toward a formalized fund. But any other anecdotes or even advice for raising a first-time fund that you've invested, I think you said, in 17 other funds. So what kind of coaching do you give maybe emerging managers? Anything we haven't covered?
So the first thing, I talk to a lot of people like breaking into VCs. I do probably 10 calls a month with emerging managers trying to raise their first fund. And the first thing I would say is I hope you have a lot of rich friends, because that's where your first close is going to come from. If you don't have a lot of rich friends, good luck. I hope you have your own money, because it's very, very difficult to get institutional LPs do not invest in fund ones. That's just the way it is. So you need a couple things. First, you need a bunch of rich friends. Second, you need a track record. And that track record can be your angel track record. So for example, in my case, so I'm like, and even if it's small checks, like let's say you have $100,000 of your own money, you have a thesis, go invest $5,000, in 20 companies on that same thesis. And prove that you can pick, that you can get, because to be a good manager, you got to prove you can pick, you can get the allocation, and that you can win. Pick, win, and support the companies. So you need to show a track record doing that. And the important part here that I tell all emerging managers is that track record has to be the same thesis that you're doing. So for example, in my fund, I had done 200, before this fund, I did 250 angel investments. But I was kind of an any good deal invest in whatever the fuck I wanted type of thing. And I can't use that track record to prove that I'm going to be a good B2B software investor. So the track record I talk about for this fund is the 74 investments that I've been making just in B2B. So I don't talk about, for example, my investment in Catalyst Fitness, which is home fitness. Even though it's a very successful company, I don't tell them that's a track record that tells you I'm going to be a good B2B software investor. One of the big problems I see with emerging managers is they say, here's my track record, and I invested in crypto and made a bunch of money, and now I'm going to go invest in climate. And LPs are like, I'm giving you money to go do something different than the track record you showed me. So you got to have a track record doing the things that you are going to do in this fund. And it doesn't have to be at another firm, but it can be an angel track record. It can be syndicates. It can be anything. But you have to prove that you can source, pick, and win deals in the thesis that you're doing. And if you have that, then you can start talking to family offices, high net worth individuals that are your second order connections, and get referrals from your rich friends who join as LPs. and you can build the fund that way. And that's what happened with my fund. Is my first bunch of LPs were people that already knew me, and then they introduced me to other people, and then I got introduced to fund of funds. The third thing I would tell emerging managers to do is go get some help and some guidance. I had been an angel investor and an LP for a very long time, but I still joined VC Lab. And VC Lab is basically the Y Combinator accelerator for venture capitalists. They helped accelerate over 50% of the new emerging manager venture capital firms that were created in the country last year. And it's a free program. You can apply. They closed their recent cohort 15. They had 3,000 people apply. They took 200 managers. So it's a very selective program. But basically, if you get into a program like that, they will help you and tell you all you need to do to raise a fund. Here's how you write a thesis. Here's how you write a deck. Here's how you talk to LPs. You'll have pitch practices. It's all the stuff that accelerators do to companies, but they do it for VCs. And even if you think you can raise a VC fund yourself, I would encourage you to go through that accelerator. I was one of the more experienced investors going through there, but I still learned a lot. I mean, the thesis that I have, B2B software that reduces friction at scale, was thesis number like 500 that I went through and A/B tested with lots of other investors, right? What you originally think you're good at may not be the thesis that is going to appeal to LPs and be replicatable and stuff like that. That trick of constraining your track record to just companies that are the same as the thesis for this fund is a piece of advice that VC Lab gave me. Because I had a track record, which was my entire track record. And they're like, that's okay, but it's a nice track record, it's good numbers, but you've got Catalyst Fitness, you've got Prometheus Energy, which is renewable, and you've got all these companies that are successful that are not what you're going to be investing in. You're going to confuse your LPs.
Yeah, interesting. That's all good advice. VC Lab how is it free? It must not be free. It must be
free.
How is it free?
They don't charge you. That's why it's free.
Right, so, but they're taking.
Well, basically what it is, I mean, it's online and it's a cohort-based thing. It's a 10-week program. But basically what they're doing, the reason they do it for free is that their core business, they have two other core businesses. Their core business is they are a fund admin manager like Carta or AngelList.
Oh, yeah.
They have software that will manage your fund for you. And if you get through the program and start a fund, they obviously they don't require it, but they would like you to be on their platform. The second thing they have is they have a fund of funds that uses those people in the cohort as basically deal flow for their fund of funds to pick the best managers they can find and invest in those managers as a fund of funds. So that's another benefit of going through the program is if you are, just like going through Y Combinator, if you're one of the top companies, they'll invest in you, right? Or maybe they invest in all of them. But that's the way they're making money is they're managing funds and they're investing fund of funds. Something like 400 VC funds went through VC Lab in 2022. They invested in 3 funds from their fund of funds, and I am one of those funds.
Oh, wow.
And so while it's not a requirement and they don't guarantee it, that's an opportunity for you. And also you're a member of a community of a bunch of other managers. And that's one of the problems of being a solo VC is, how do you meet other managers to put, rounds together? How do you share deals, share LPs and all that stuff? And VC Lab has a really great Slack community and Discord and software, and you're a part of a community of other managers. That's another benefit. It's kind of like, YC. I mean, YC has a crazy alumni network. And if you get into YC, you get access to that alumni network. There's a huge value to that for an entrepreneur.
Yeah.
It's the same with VCs and VC Lab.
I think it's super brilliant what they've done. I mean, they've had Founder Institute, which is their startup accelerator program, which is a good program, but it's not in the same caliber as YC and others. But yeah, the VC Lab is a genius way to kind of capture a different market.
It's a similar type program, but I mean, the numbers tell it. I mean, they graduated more VCs than any other program. There's one or two other smaller ones that are trying to do it, but they are definitely less in VCs.
All right. Any other advice for emerging VCs? Actually, one question. Would you recommend creating a syndicate on AngelList as a kind of precursor to starting your own fund, or is that a model that's from the
No,
2010s?
I would, because the whole question as an emerging manager, let's say you want to be a manager. Okay, how do you generate a track record? So there's a couple options. You can do angel investments, that's fine. But doing a syndicate, that's kind of leveling it up, because then you're proving that you can provide value and manage other people's money, right? Because angel investing is just your money. A syndicate is other people's money. So are you any good? Like, for example, one of the reasons I think VC Lab liked me is I have one of the largest syndicates on AngelList. The first 50 LPs were all my friends, but 2,900 of the people, were attracted to my syndicate because of the quality of the deals and all of this other stuff. Like, there are people that I have a little bit more of an argument. It proved that I was able to convince 2,900 people to invest with me who I did not have a personal relationship with, which is an important part of a track record for a manager.
For sure. But do you think, because I remember when AngelList came out with their syndicates, which is also a very brilliant idea, but that was a while ago. I don't know exactly,
Yes.
15 years ago. I guess
Yeah,
my
long
question
time.
is kind of, could you still go on there today, start a new syndicate, and build a pretty organic base of LPs?
Well, I think it's a lot less likely. Angel investing through AngelList in general is down quite significantly. In 2021 and 2022, there was a ton of activity. I was filling, there were lots of people joining, lots of people writing checks. I was filling allocations in like 24 hours for $500,000. Like, it was crazy. But you do a syndicate now on AngelList, and there's like 10% of the activity. There's just a lot less angels active on AngelList overall. And I heard some statistic at the liquidity conference that something like there's like 3,200 syndicates on AngelList. Something like 60% of their closed deals happen through 4 syndicates. So there's definitely a power law on AngelList for the syndicates that are big and good. But I definitely, even if you don't use AngelList, you could use Carta, you could use Sidecar. There's other syndicate platforms. But the cool thing about syndicates, you don't have to do AngelList. But what you're trying to prove, building your emerging manager investment criteria is can you convince other people to invest with you?
Mm-hmm. Yeah.
Even if it's 20 or 30 of your friends, and you're doing private syndicates. Like, can you identify companies, get allocations, and convince other people to write a check?
Yeah.
That's a level up from just your own ability to write checks.
Sure. Very cool. What have we not covered? We've covered a lot already. I won't keep you too long, but one question I'd like to ask: if you were doing this all over again, what advice would you give your younger self? If kind of on the way to like how to become a VC, anything you do?
How to become a VC? Well, the best way to become a VC is first make a giant pile of money, and then start investing. People who try to invest before they have a giant pile of money, doesn't go well. Angel investing on your own, not as a professional investor, trying to pick your own deals at the local angel network, is very, very hard, has a very low success rate. So unless you don't need that money anymore, I wouldn't really do it. The only reason I decided to be a professional investor is that when the pandemic struck, I had been a CEO 3 times, and the CEO is a really hard job. CEO is, a 70, 80 hour a week job with employees for your responsibility, shareholders, stuff like that. The investor is a much better work-life balance. For example, next week I'm going to Europe for a month. I can do that. I can do my VC job from Europe. I could not leave if I were CEO, my job, right? So a lot of it is, having the ability to do a better work-life balance. I'm not sure you would get that work-life balance if you were an associate at a big VC fund. You would still be working like an analyst at an investment bank, 80 hours a week. So the way I ended up as a VC is that I made a bunch of money and realized I didn't want to be a CEO anymore, and that I could be helpful to other founders, and that this is what I want to do with my life now. With the rest of my life is I want to be an investor, and I want to help young entrepreneurs for the rest of my life. And it's something I could do for the rest of my life. I don't think I could, go and do the amount of work that I did in my 30s as a CEO again. Frankly.
Do you still have to hustle to get good deals, or is it as your?
Oh, you have to hustle a lot as a VC. Yes.
I guess what I'm saying is like, is that the hardest part of the job for you? Or what is the hardest part of the job for you? Getting good deals or something else?
Deal flow is not a problem for me because I've been doing it for so long and I know
Right.
so many GPs and I have a decent media presence. The hard part of the job is making the decision because it's a one-way door, right? I mean, you write the check and it's gone. You have to make good decision quality. And that's why I added a whole bunch of new processes to support my companies for follow-on financing, all that stuff. I'm doing it as a professional, and I'm spending as much attention to it as I would as a CEO. And I think that attention helps me be more successful as a professional VC versus as an angel. Because as an angel, you're writing checks and you're doing something else for your day job, and you're basically not paying a lot of attention to it. And you got to understand that track record is going to be a lot less successful than if you are spending 30% of your time supporting your founders, which is what I do, and versus finding new investors. The hardest part, though, is getting to conviction, right? I have 7 checks I can write a year. Last year, I got 3,500 companies to look at.
That's hard.
So the question is, am I picking the right 7 out of 3,500? One thing that I just did to improve my decision process, which I don't know if I'm going to like the results, but I'm a nerd about decision quality. I wrote a tool which figures out an anti-portfolio for me. So it goes through the 2,993 that I said no to and tracks what happened to them on Crunchbase over the year. And I want to know if I said no to something that turned out to be quite successful. I want to know if I made a mistake. And then I'm going to go back and look at those and say, what did I miss? I actually heard Toby Lutke just talking about this. He met up, he's founder of Shopify, and he met up with it was hard for him to raise money, and a bunch of VCs turned him down. And about a year ago, he met up with a VC who turned him down, having coffee. And the VC asked him, he said, Toby, what did I miss? I told you no. And I want to know, what did I get wrong? And he said, you didn't miss anything. You made exactly the right decision. And the decision the guy made was, at the time, there was approximately 40,000 e-commerce sites running software. And Toby's like, we're going to make a better e-commerce software. And the VC's like, okay, great. But if you get 50% share, there's only 20,000 customers. That's not a very big business. This looks like a small business. And what Toby said, the part you missed, your analysis was correct on the size of the market at the time. It would have been a very small business. What you missed was the fact that the existence of my business, the reason there was only 40,000 is because it was hard, it was expensive, it was a pain in the ass. Yeah. I was making it an order of magnitude easier. And today there's over 1 million companies on Shopify alone. So the existence of the success of my platform increased the size of the market. That's what you missed. You didn't believe that the existence of my company would make the market 100 times larger than it was at the time you analyzed the market. That's what you missed. And the VC's like, you're right.
That's awesome. That's a great anecdote. So going back into your little machine, have you found any of those 3,490?
I have not completed the analysis yet, but I'm hopeful that I do find some. And when I go back, I can identify what did I miss.
Yeah.
Because if I can identify what I missed, then I can make better decisions going forward, right? This is all about trying to improve your decision, because you can't change the decisions you made in the past, but you could change your algorithm for making decisions in the future, which is what I'm trying to do. I'm trying to get better at making investment decisions. The hardest part is, I got 3,500 deals and I decided to write this one check. Is that the right check?
Yeah. Yep.
You won't know for 5 or 7 years.
Yeah. It's there's some analogy to marriage in there somewhere, right? You've dated X number of, did I pick the right?
That's true. Yeah. The secretary problem.
Yeah.
It's called the ultimate stopping algorithm. There is a certain, I think it's 33%, but there's a certain, like if you want to hire a new secretary, they call it the secretary problem. The question is, how many secretaries do you have to interview before you can make a decision? You should never hire the first person you interview, or the second, or the third, or the fourth. It turns out it's about 33%. And it's the same thing for like apartments. Like you're trying to find an apartment. Like how many apartments do you have to see to be able to make a decision? And if you think you can interview 100 people for a secretary, you should feel comfortable making the decision after you've interviewed 33. Now you may go back and hire one of those 33, or you may hire number 34, but 33% of the total sample size gives you enough information about the potential pool to be able to make a decision. And it's very similar in venture capital. Let's say I'm looking at, like, I looked at a company, I invested in a company called Sensate, which is it's a vagus nerve stimulator. It's basically technology-assisted meditation. It's for increasing calm. I look at the company, I like it, but then the question is, can I make a decision seeing only one company in that area? Well, no, you can't. So I said, I'm going to go buy 20 devices that say they do something similar. I'm going to review all of them. And after I looked at 20, I was then able to make a decision on which of those 20 I could invest in, because I had seen enough of a sample size. And that's what professional VCs do, right? Every pitch that I get, I have probably heard before.
Yeah, right.
And so then the question is, have I heard enough of them to have an opinion or be educated enough to be able to make a decision?
Interesting. 30, just to clarify, you need to have a sample size of at least 30 or 33? Or
No. Well, whatever your sample size is, whatever you have time to do. Let's say you're looking for apartments and you need an apartment in a month. Then the question is, how many apartments do you think you can see in the next month? Let's say you think you can see 20.
Sure.
Right? Well, after you see 6 or 8, you should then feel comfortable making a decision.
Gotcha. Okay. So once you've seen a third of this total sample size.
Once you've seen a third of the total sample that you think you could sample prior to when you have to make the decision, you should feel comfortable making a decision.
You've got enough. Gotcha.
And by the way, if you get into 70 or 80%, there's a huge diminishing return for seeing one more. Let's say you could see 20 apartments and you've seen 15. What's the marginal value of one more apartment? Really low, right?
Sure.
Just pick from the 15 you have.
Gotcha. Interesting. I haven't heard that rule of 33% sample size.
Well, it's called the ultimate stopping problem or the secretary problem. You can look it up on the internet. There's other people that explain it better than me. But if you're trying to make a decision from multiple choices, that's the algorithm that tells you how many choices you should review before you make a decision.
Yeah, interesting. All right. Well, this is really interesting. Lots of good stuff in here. If people want to learn more, it's Incisive.vc. And
Incisive.vc. The best thing to do is follow me on Twitter, which is at Martin G. Tobias.
At Martin G. Tobias. Great. Last question. Have you invested in anything that's come over Twitter, like someone that's you've interacted with, or?
Yes, I invested in 2 companies who cold DM'd me on Twitter, one in Africa and one in Sri Lanka.
Oh, wow. Interesting. Cool.
Yes.
In Africa, you said?
Yes. So I do respond to Twitter posts, but on my Twitter feed, it says, apply here using my form, please.
Yeah. Wow. That's amazing. Cool. All right, Martin, thank you so much. Lots of interesting anecdotes and insights here. And best of luck, and we'll catch you after your next fund, whatever that might be, your $100 million fund, when you go from 10 to 100, right?
Thanks for doing this, Nathan. I've really enjoyed it.
All right. Over now. Appreciate it. Bye.